Tuesday, May 22nd, 2025, etched itself as a day of significant turbulence on Dalal Street. Indian stock markets experienced a sharp downturn. The benchmark indices, Sensex and Nifty, both recorded substantial losses. This unexpected plunge sent ripples of concern through the investor community. Many were left wondering about the underlying causes of this sudden market fragility. The air was thick with questions and a palpable sense of unease. The preceding days had already hinted at potential volatility. For instance, on Tuesday, May 20th, markets had witnessed a considerable sell-off. The Sensex had fallen over 800 points, and the Nifty had also seen a significant drop. This earlier decline had already eroded substantial investor wealth, setting a cautious tone. Therefore, the crash on May 22nd did not occur in complete isolation. It seemed to be an escalation of pre-existing pressures and emerging global uncertainties. This essay aims to decode the events of May 22nd, 2025, offering clarity on the major factors that contributed to the market mayhem. By breaking down these components, we hope to provide a clear picture of why the markets reacted so strongly, helping you make sense of the turmoil. The trading session on May 22, 2025, was characterized by persistent selling pressure from the opening bell. The Sensex, the Bombay Stock Exchange's benchmark index, opened weak. It continued to extend its losses as the day progressed. Ultimately, the Sensex closed at 80,951 points. This represented a substantial fall of 645 points from its previous close. Similarly, the Nifty 50, the National Stock Exchange's flagship index, mirrored this downward trajectory. The index breached crucial support levels during the session, at one point slipping below the 24,650 mark. By the time the market closed, the Nifty 50 had settled at 24,609 points. This was a significant decline of 204 points. The fall indicated widespread selling across various heavyweight stocks that constitute the index. The broader market indices presented a somewhat mixed yet predominantly negative picture. The BSE Mid-Cap Index registered a fall of 0.33%. The India VIX, a measure of market volatility, also surged by 3.7%, indicating heightened nervousness and uncertainty among traders and investors. One of the primary global factors contributing to the market unease on May 22, 2025, was the escalating concerns surrounding U.S. debt. Reports indicated rising U.S. bond yields. Alongside this, a widening fiscal deficit in the United States was shaking global investor confidence. These developments in the world's largest economy often have far-reaching consequences. They tend to create a risk-off sentiment across international markets, and India is no exception. When global investors become nervous, they often pull capital from emerging markets. Context from earlier in the week showed that Moody's had reportedly downgraded the U.S. sovereign credit rating. This was attributed to the country's growing debt and persistent political disagreements regarding fiscal policy. The impact of rising U.S. bond yields is particularly significant. Higher yields in the U.S. make American government bonds more attractive to investors seeking safer returns. Therefore, the nervousness stemming from the U.S. fiscal situation played a crucial role in the negative sentiment on Dalal Street.
Factor that cast a long shadow over market sentiment was the resurgence of geopolitical tensions in the Middle East. News of fresh clashes in the region began to circulate, creating an atmosphere of uncertainty. Geopolitical instability in this oil-rich region almost invariably leads to concerns about crude oil supply disruptions. True to form, crude oil prices started to climb in response to these developments. This rise in oil prices added another layer of worry for the global economy, and particularly for net oil importers like India. India relies heavily on imported crude oil to meet its energy demands. Therefore, any significant spike in global oil prices directly impacts India's import bill. This can widen the current account deficit and put downward pressure on the Indian rupee. Higher oil prices also translate into increased input costs for various industries. The combination of worries about oil supply, potential inflation, and general global instability created a potent mix that weighed heavily on investor sentiment. Beyond global concerns, specific domestic factors also played a crucial role in the market downturn on May 22, 2025. The information technology sector, a heavyweight in the Indian indices, faced significant selling pressure. This weakness in IT stocks was largely attributed to analysts' predictions of a potential slowdown in global technology spending for the upcoming fiscal year, FY26. The IT sector declined by over 1.2% on this day. Major constituents like Infosys and TCS were among the top drags on the indices. Adding to the day's volatility was the weekly options expiry for Nifty and Bank Nifty contracts. Derivatives expiry days, especially weekly expiries, are often associated with increased market choppiness. On May 22nd, aggressive unwinding of positions was observed in both Nifty and Bank Nifty options. The combination of negative global cues, sectoral weakness in IT, and the volatility induced by derivatives expiry created a perfect storm for a significant market correction. Section 6. The inevitable correction profit booking after a strong market run. Another key reason for the market fall on May 22, 2025, was simply the phenomenon of profit booking. Indian markets had experienced a strong run in the preceding month. When markets rally significantly over a period, they often reach levels that some investors perceive as overvalued or ripe for a pullback. Consequently, these investors choose to sell a portion of their holdings to lock in the gains they have made. This activity, known as profit booking, is a natural and healthy part of market cycles. The profit booking on this day appeared to be quite broad-based, though it was particularly noticeable in sectors that had performed well recently. Thus, the downturn on May 22nd can be partly seen as a natural breather after a period of strong gains. On May 22nd, 2025 did not impact all sectors equally. The IT sector was a significant casualty, declining by over 1.2%. The auto sector also experienced a sharp downturn, falling by 1.5%. Key auto stocks such as Mahindra and Tata Motors saw substantial corrections. The FMCG sector, often considered defensive, was not spared either. Prominent companies like ITC and Hindustan Unilever witnessed significant selling pressure. The power and oil and gas sectors also remained under stress. Amidst the widespread declines, there were very few pockets of resilience. The media index was a notable exception, being the only sectoral index on the National Stock Exchange to close in the green. It managed a modest gain of 0.3%. However, this small island of green was insufficient to counter the overwhelming red that dominated the market landscape. Section 8. The big players' moves, institutional activity, and expert commentary. The actions of institutional investors often provide insights into market sentiment, and May 22, 2025 was no different. Foreign institutional investors, also known as foreign portfolio investors, were reported to be net sellers in the Indian equity markets on this day. Their decision to sell was largely influenced by the prevailing global uncertainties, including the U.S. debt concerns and geopolitical tensions. FIIs manage large pools of capital, and their selling can significantly impact market direction. This trend of FIIs being cautious was also observed earlier in the week. In contrast to FIIs, domestic institutional investors, which include entities like mutual funds and insurance companies, often act as a counterbalancing force. On May 22nd, DIIs reportedly attempted to mitigate the market fall with selective buying. While DII buying can provide some support to the market, it was not enough to completely absorb the selling pressure from FIIs and other market participant investors. Following a sharp market correction like the one on May 22, 2025, investors often wonder about the path forward. It is crucial to remain calm and focus on fundamental factors rather than reacting impulsively to short-term volatility. One of the most important things to monitor in the coming sessions will be global market movements. Pay close attention to commentary from the U.S. Federal Reserve, as their stance on interest rates and inflation significantly influences global liquidity. Crude oil price fluctuations warrant careful observation. Given India's import dependency, sustained high oil prices can negatively impact inflation, the fiscal deficit, and corporate earnings. The flow of investments from foreign institutional investors will be another critical factor. A return of consistent FII buying would signal renewed confidence in the Indian market. Prudent investors should focus on their long-term financial goals, maintain a diversified portfolio, and consider systematic investment plans to navigate such volatile periods effectively.
Follow at Dalal Street Decode for tomorrow's episode.